Hello everyone, and thank you for joining us for the first Tax Insights Live session of 2026. Hope you all had a good end to 2025 and a good new year. Today's session is about UK tax red flags for lawyers, and it's aimed at lawyers who are not tax specialists but who routinely work on transactions and matters or structuring work where tax issues sit just below the surface. And I'm sure that we've all worked on matters where people say it's tax driven, structure's tax driven, get the tax advice first, and so on and so forth. So it's aimed at lawyers working with matters where there is a significant tax angle, but who aren't actually tax specialists themselves. And the purpose of today is to not turn other lawyers into tax advisors, but it's to help you recognise when something feels tax driven in a risky way and why that risk matters. It's to understand why that matters for you and your client, and how to protect yourself, and when you might need to actually escalate or step back if something is just too risky to proceed. So why do we need to worry about this at all? Why does tax awareness matter? Well, there's been an increased HMRC scrutiny of tax matters over recent years. I'm sure we've all seen various things in the papers at particular times. Professional and regulatory exposure gets greater and greater every year. Potential criminal liability, if we're aware of tax risks, fraudulent tax planning, which we don't report. And there's reputational and negligence risk for all of us. So the tax risk isn't just a commercial issue. It cuts across professional conduct, money laundering and criminal liability, negligence, reputational damage, lots and lots of different areas. So it's a really key and important area. And regulators do expect lawyers to be aware, whilst they don't expect non-tax lawyers to be specialists and be into the detail. They do expect everybody to be aware and to be mindful of tax risk when they're working with their clients. You don't need to be able to solve tax problems necessarily, but you do need to be able to spot where you should be able to see that something isn't quite right. And as we go along today, we're going to talk about a number of cases at a very high level that are examples of the various matters we're going to talk about. The first case we're going to talk about that some of you may be aware of is the Ramsey case. So this is known as the kind of leading case in UK tax about artificial steps and purposes of lack of commercial purpose in transactions. It's the foundation of the UK anti-avoidance approach, really. And essentially, it's important if the structure looks clever but only works on paper, and it seeks to prevent clients using artificial and circular transactions. The courts will ignore pre-planned, circular, self-cancelling steps that are only in existence to generate a tax advantage. So, as we've mentioned, key red flags here really are circular transactions, various steps with no commercial impact, and structures that only make sense on paper. So these are the really complex structures with lots of steps, often involving overseas entities, often marketed as tax schemes, that actually the commercials don't match the tax complexity because the series of steps is more complex than it needs to be in order to gain an artificial tax advantage. So the lawyer's role here is not to be a tax advisor, as we've said, but can't be blind either. You're not expected to provide tax advice unless that is your specialism, but you can't ignore tax issues if they're obvious or central to what you're being asked to do. And it helps here to think about three different concepts. There's legitimate tax planning. So taxpayers are entitled to arrange their affairs in a way that gives them the best tax result, but that has to be within the spirit of the arrangements that as Parliament intended them to be when the legislation was drafted, with genuine commercial substance behind them. Then we have aggressive tax avoidance, so arrangements that technically comply with the law, but rely on the artificial steps and the complexity that we've talked about, or exploiting gaps, loopholes, and so on to achieve a tax result that Parliament never intended when the legislation was drafted. And then finally, we've got tax evasion, which is dishonest or concealed, so it's criminal. So you can see there is what we call vanilla tax planning. There is the evasion, which is the plainly illegal planning, but then there is the grey area in the middle where we have to be really careful. Is it good tax planning, or is it into artificial structuring that was not what Parliament intended when they drafted the legislation? And your risk as a lawyer arises at those boundary areas, actually, because obviously a client or another advisor who's marketed a scheme is going to be trying to convince you that it's all fine, it's all above board, all the steps are within the spirit of the legislation. But where the boundary is between tax planning, particularly aggressive tax planning, and tax evasion, that's where the risk lies, particularly where you're asked just to paper a structure, just to draw up some paperwork to back it up. The commercial rationale for each step is weak or unclear. A red flag here is if nobody can quite explain why a step needs to be there, but the person who's designed the scheme from a tax perspective just says it has to be, but nobody can really explain why it's commercially required. And the client's behaviour raises concerns, and we're going to talk a little bit later about client-specific red flags. So the key question isn't necessarily, is this legal tax planning, but am I facilitating something that's artificial, that's misleading, is not within the spirit of the legislation as it was intended. And the next case we're going to mention sort of shows the flip side of that. So that the Barclays case said that it clarified that having a tax motive isn't actually fatal. It doesn't mean, just because there is a tax advantage, it doesn't mean that the transaction is doomed to fail. The courts will respect genuine commercial transactions as if they have a genuine tax result, as long as there is a genuine commerciality behind it and it's not purely tax driven. So you're not expected to challenge every tax efficient deal. In this case, there was this case surrounded capital allowances on pipelines, essentially. And the courts concluded that just because it was a tax advantageous arrangement, it didn't necessarily mean it was abusive, and it was unacceptable, and it was allowed, and the company could claim the capital allowances. So this shows that the other side of what we've just been discussing, that just because it's tax advantageous doesn't mean it's wrong. It's the artificial nature and the lack of commerciality that are the real red flags. So firstly, in terms of structural red flags, so a major red flag is over-complexity with no clear commercial rationale. So now you have to ask yourself, would this structure exist without the tax benefit? So if it wasn't for the tax result, would anybody have entered into these series of steps as they've been designed, or are they overly complex just to gain a tax advantage? And can the client or the scheme promoter, if there is one, whoever's suggested the scheme, can they explain it in plain English? Can they say why each step needs to be there in a way that logically makes sense? Examples of steps which would not make sense include circular flows of funds, where the funds flow between entities simply to end up with tax deductions being created. Entities that only exist briefly, that are incorporated and then are closed down very quickly. And steps that completely cancel each other out apart from tax effects. Those are all red flags, because you see commercially they wouldn't need to be there. They're just there to gain the tax advantage. And another red flag that I'm sure that we've all come across is the use of offshore entities in low tax jurisdictions or no tax jurisdictions where there's no obvious operational reason for it to be there. That's always a red flag. Offshore doesn't always mean wrong. It can be acceptable, and there can be a reason to use an offshore entity. But if it's there for no commercial reason apart from to gain a tax advantage, that's when the red flag should appear. And questions around overseas entities include: who controls the entity? Where's the real decision making happening? Is the decision making happening in the country in which the entity is incorporated, or is it all being run from overseas? And is there genuine substance in that country? Is there any substance behind having an entity there? Other things to watch out for would be separation of value, risk and ownership. So where you've got profits allocated to entities where there are no people or no activity, that's a red flag. And risks moved away from the people that actually manage them, because you'd usually expect risks to be aligned with the people who are managing the risk, wouldn't you? And if that's been separated artificially, that can be a red flag. And then finally, be cautious where a scheme has been designed around a relief or an exemption or a loophole, rather than actually starting with the commercial impact and then working the tax around that. there's a balance to be had, isn't there? Because as we said at the beginning, lots of structuring work is going to be tax driven. You know, it has to have a tax input really early on. But there's the cliched saying that people sometimes say is don't let the tax tail wag the dog. If you're designing your whole commercial arrangements just around the tax advantages, then that's likely to be bordering on the kind of grey area where the risks start to lie. A key case here is the Furness and Dawson case, and the Dawson family owned shares in UK companies. They were incorporated and resident in the UK, and then there were negotiations between the Dawsons and a third-party buyer to buy the companies. Perfectly normal up to this point. Then it was agreed that the purchaser would purchase the companies, but somebody along the way, one of the advisors, designed a trick to avoid capital gains tax. So they said, we will put in place, stamp duty was designed to mitigate. So we will put in place a holding company, an Isle of Man company, transfer the shares tax-free to the Isle of Man company, and then sell the shares in the Isle of Man company, therefore avoiding the capital gains tax and the stamp duty issue. The problem here was that holding company structure was put in place solely to obtain a tax advantage. There was no real commercial reason for doing it. The red flags here were last-minute insertion of entities before a sale, pre-sale reorganisations, and no real change in the commercial position. So that was the problem with this case. So the next category of red flags that we'll have a look at is documentation and execution red flags. So here we're looking at the mechanics of actually implementing transactions and where the red flags might appear there. So backdating or altering timelines. People very often will ask to backdate documents to try to make sure things have happened perhaps before a change in legislation or a deadline or so on. Backdating always a huge red flag and essentially doesn't really work. I think most of the people on this call are lawyers, and most of the lawyers we talk to would agree that backdating just generally doesn't work. But also side letters, informal understandings, paperwork designed around the tax narrative, and last minute changes which are solely tax driven. Anything to do with amending dates, amending documentation, leaving steps undocumented, all these sorts of things are red flags in terms of execution. And the Furness and Dawson case that we just mentioned is an example of this type of risk as well. So just having documentation in place to insert that holding company didn't solve the problem that it was a tax red flag because it was an artificial step. So these are the red flags we look out for when clients just want paperwork to support the tax analysis or support the tax treatment, these kind of words that people will say when they're trying to get something designed essentially to achieve an unintended tax outcome. So we'll look more specifically at specific practice areas. I think we've got a variety of people on the webinar today from different areas. So we'll ground it in some real practice area snapshots. So corporate M&A, I mean, we talked about some of these before, but pre-sale reorganisation shortly before completion doesn't necessarily have to mean it's not acceptable, but does need to be looked at because the risk here is that things are being rearranged away from their commercial reality in order to provide a better tax result, tax advantage. Share for share exchanges, share for asset exchanges, swaps with limited commercial change. So where the commercial basis of the entity isn't being changed, but these transactions are being entered into, then that is a red flag. And again, not necessarily completely unacceptable, just means it needs to be looked at and advice needs to be taken. Last minute insertion of new entities to optimise tax. I mean, we talked about the insertion of the holding company a few moments ago. On the property side, stamp duty land tax, lots of mitigation schemes here involving subleases, leases or options, and unusual lease structures that appear to exist solely to reduce stamp duty land tax. In terms of employment, loans instead of remuneration, this has been a huge one in recent years. We're going to talk about a case in a moment. Loans instead of remuneration are a big red flag, because obviously the individual is then avoiding the income tax, and both the individual and the company are avoiding the national insurance contributions. So that's the big risk there. Offshore trusts or vehicles paying individuals who work in the UK, and any arrangements marketed as tax efficient alternatives to salary. So anything that sounds essentially too good to be true, these kind of arrangements are often marked as tax efficient alternatives. Definitely a red flag there. And I think with all of these types of schemes, as a non-tax specialist, you're not expected to do an analysis of whether they work or not, but it's recognizing that there is elevated risk in these scenarios and advising the client to obtain tax advice. I think that's as far as you would need to go, but you can't just ignore it if you're not a tax specialist. So a couple of case examples here. The Pendragon case related to VAT on what they call demonstrator cars, which have been displayed in a car dealership showrooms run by the Pendragon Group. The group consisted of a holding company, 4 dealership companies, and 3 captive leasing companies, and then another sales subsidiary. It's quite a complex group. So the dealership companies sold the demonstrator cars as second-hand cars, and under the VAT regulations at the time, dealers in second-hand goods are allowed to charge VAT only on the profit margin in certain circumstances. So obviously they are going to be able to charge their clients lower prices because they're not having to charge the full amount of VAT. So Pendragon, and this was a KPMG designed scheme, put in place a complex structure which enabled them to recover input tax on the price of the cars while avoiding the output tax on the sale of the cars to consumers. So HMRC successfully argued that this was an artificial setup because the group was so complex, that the transactions were an abusive practice, because the fragmentation of the activity and the complexity of the group was solely for tax purposes. They looked at substance over form, what's really going on here, and the artificial VAT structure was successfully challenged. Another useful case here on the employment taxes side, and this was a very famous case at the time, was the Rangers case, also called the Big Tax case, and loans via employee benefit trusts weren't being treated as earnings. So footballers were being remunerated through loans, which essentially were never going to be repaid. And the result of the case, after a huge amount of time, huge amount of media coverage, was that the loans from the employee benefit trusts were treated as taxable outcome, taxable earnings. That was the outcome. So just labelling something a loan didn't actually make it a loan, essentially, at the end of the day. The red flags here were the loans instead of salary, as we said earlier, the use of offshore trusts, and long-term non-repayable loans. Huge red flag there, because the loan was just intended to sit there forever. And there were major reputational damage. There was major reputational damage as a result of this case. If you follow football, you may know that the club actually went into liquidation at the time, and then its successor club had to start again right at the bottom of the football leagues and work its way back up, because the debts of the club, including the tax debts, were so great that it ended up in liquidation. So huge commercial impact and reputational impact of using this tax scheme. So now we're going to have a little bit of interaction. We're going to have a poll. Now, I haven't done one of these before. I am reassured that the tech is going to work. So we'll give it a go. If it doesn't work, then we'll just move on. So I've got 4 scenarios here, and we're going to, the question is this a tax red flag in this case? So, right. Can you see that on your screen? I don't know if anybody can. Perhaps let me know in the chat or vote in the poll. We've got votes. Excellent. So a client asked to insert an offshore SPV into a deal 1 week before completion, simply saying our tax advisors say it's standard. Okay, I'll give you another 10 seconds and I'll close that poll. Okay, right, let's end the poll. Yeah, and yeah, everybody said yes. I mean, the risk here is that it is a last minute transaction just before completion. So the timing, the lack of substance, and the reliance on the tax advisor, the advisor's assurances that yes, it's fine, everybody does it, it's standard, no real commercial substance. That's the red flag there. Right, next poll. Scenario 2, a client provides glossy tax advice from a scheme promoter and asks you to implement the structure exactly as described. They feel reassured as the promoter has explained to them that the scheme is backed by a King's Counsel's opinion. So is this scenario a red flag? Okay, I'll give you another 10 seconds. And end the poll. Yeah, again, this is a red flag. So promoter-led schemes are a common feature of challenged arrangements. So promoters tend to be firms of advisors who market very expensive tax schemes. They charge premium fees for these tax schemes, and they market the artificial series of steps, which, as we said earlier, is a red flag in itself. But the big red flag for me with these is that they are trying to change a client's circumstances to fit them into the steps that they have worked out in advance, rather than fitting the tax advice around the commercial substance. So yeah, this scheme promoter, any kind of promoted not bespoke scheme, is a red flag. The reassurance saying the scheme's backed by a King's Counsel's opinion. I mean, there's all kinds of issues with this, but essentially clients can't rely on that opinion because it doesn't relate to them and their case and their fact pattern. So although the promoters will very often reassure clients, that the King's Counsel has approved the scheme, which sounds great if you don't understand kind of quite how the reliance would work, but actually the clients don't have anything to fall back on if it all goes wrong. Right, the third scenario. A client asks whether documentation can reflect a different completion date, in inverted commas, for tax purposes. So thinking about the red flags that we talked about earlier, we talked about the kind of documentation and timing red flags. So yeah, if a client, perhaps with advice from their promoter, scheme promoter, asks whether the documentation can reflect a different completion date for tax purposes. A few more seconds. Okay, yes, as everyone agreed, major red flag. Anything to do with trying to pretend that things didn't happen as they actually did happen is a major red flag, and moves from avoidance and planning and the grey area into the evasion and just dishonest conduct. So anything to do with that, we would need to consider our position. And then the final question, scenario 4. A UK trading company undertakes a group reorganisation 6 months before a sale. This aligns legal entities with existing business lines, simplifies management and reporting, and has the effect of qualifying the shareholders for business asset disposal relief on an exit. Independent tax advice has been taken and the steps are fully documented. Okay, a few more seconds for that one. End poll. Yeah, so no, that one, obviously that sounds much more commercially driven, properly advised, has a tax benefit, but the commercials haven't been changed to fit in with, with tax, artificial tax steps. Now, obviously, I appreciate those examples are very, very, very simplistic and for illustrative purposes. In real life, as always, it's never quite that straightforward, is it? But you can see how it would arise that, that some scenarios are okay, even though there is a tax advantage, that's acceptable because it's within the spirit of the legislation as Parliament intended it. Other steps are artificial and designed to achieve a tax advantage, which was never intended when the legislation was drafted. So moving on from the sort of sector-focused red flags and onto client behaviour red flags. What do we need to look at when we're working with our clients or other advisors that they are using as well? So sometimes the biggest warning signs come from how people behave, don't they? Whether that's clients or whether that's other advisors. Particularly, I mean, you often find, don't you, if somebody becomes kind of aggressive or defensive, sometimes it's because they can't actually explain what it is that answer your question in plain English. But always be really alert if a client asks for anything guaranteed, HMRC proof, risk-free, all these types of words. Dismisses HMRC scrutiny, resists independent advice. Most clients who are trying to do things the right way and within the law will understand that there is a risk attached to most things. And what our clients say to us is that what they want and what they value about us is not that we will just say don't do it, or this is absolutely fine, but we will say there's a risk here, but it's a low level risk, or this is a really high risk, you must not do this. So it's looking at the levels of risk, isn't it? Anybody who is seeking something where you are going to promise them it's risk free would be a red flag for me. Anybody wanting minimal documentation or disclosure, don't write this down, want this on a call with nothing recorded, so on. Obviously, red flag here. Other phrases which would make you pause. Everyone does this. HMRC won't find out. We just need you to paper it. I always think that expression is designed to kind of make it sound not quite as bad as it is. Other firms have done this before. It's backed by a KC opinion, as I said earlier. Particularly dislike that one. I think it's deliberately designed to falsely reassure clients. I think it's particularly bad. But all these kind of phrases, really should make you pause and think, what's going on here. It suggests a mindset in the client or the advisor that may expose you to professional and regulatory risk. So you need to be really, really careful. So in terms of a very short case study, I was just sort of thought through, how does all this come together? So let's say we have and this is a fictional case, by the way, but let's say, just for example, we have a long-standing corporate client who proposes a pre-sale reorganisation involving multiple offshore entities. Stated purpose is tax efficiency. The advice comes from a boutique tax promoter. The client's keen to move really, really quickly and asks you to draft the documents. So key questions to consider. What are the tax red flags here? I mean, we've talked about most of them already. Complexity, offshore entities, promoter advice, timing, rushing it through, not taking the time to take proper tax advice, all these kinds of red flags. But if you're involved in this as a legal advisor, what's your risk? Facilitating an artificial structure, potential money laundering issues, negligence exposure. So really significant for advisors. What should you do in summary? Pause, try and slow everything down, try and say, right, we know this needs to be done at pace, we understand that there's a deadline, but we need to get the proper advice, and we need to make sure that everything's in place before we conclude this, to ensure that nobody is exposed to unnecessary risk. Clarify the commercial rationale. Strongly recommend that the client seeks independent tax advice, and obviously, depending on your role within your organisation, you may need to escalate internally to those more senior to your money laundering reporting officer if you consider that the risk is such that it needs to be escalated and there is an actual money laundering risk. When might you actually decline to act? Always a tough decision to make, isn't it? None of us want to be turning away work, but sometimes you really do have to. If concerns are not addressed, you're trying to slow people down, trying to insist they get proper tax advice, but they insist on, forging ahead without those things, then, that might be a cause to actually say, we can't act anymore. If explanations are inconsistent, you hear one thing one day and one thing the next day, and it just doesn't add up and you can't get to the bottom of it. And pressure continues, particularly, as I said earlier, when people turn aggressive, put unnecessary pressure on. Sometimes that can be because they're trying to intimidate us into doing something we shouldn't be proceeding with. So those are the kind of issues when we look at this kind of from a case study point of view to bring everything together. One other thing I wanted to mention is the GAR, the General Anti-Abuse Rule, which came in 2013 to seek to counteract abusive tax arrangements. And the GAR advisory panel provides judgments on this, and they look heavily at abnormality and lack of commercial purpose when deciding whether arrangements are abusive or not. So things like highly contrived arrangements, promoter-led schemes, reliance on technical loopholes, all these sorts of things are kind of key when the GAR advisory panel is making its judgments. And if in looking at whether arrangements are abusive, we have what we call a double reasonableness test, which says that we need to think about whether the arrangements could reasonably be considered to be a reasonable course of action. So it's kind of seeking to be a common sense thing, isn't it? It ties into what we said earlier. Would these steps make sense if it wasn't for this tax advantage being there? And obviously the GAR is very, very wide ranging. So it does seek to counteract these abusive contrived tax arrangements. So in anything that we do, aside from looking at targeted anti-abuse rules, we also have to be aware of this general anti-abuse rule, seeking to counteract contrived and abusive arrangements in everything that we look at. So having talked about the red flags, what should you do when you do spot a red flag? We've covered some of these already, so I won't spend too long on this, but pause and document concerns. So make sure you've got a note of, perhaps a conversation where somebody became aggressive or someone tried to put the timing pressure on or so on. Ask neutral and factual questions. So, we all know, don't we, on these, kind of things, sometimes you have to sort of stay calm, stick to your guns, ask for the facts, even if you're not getting them. Escalate to tax specialists, whether you have a tax department in your firm, you might be able to go to them and just say, I'm just really concerned about this. It just doesn't seem to make sense. What do you think? Or to external advisors, if appropriate, if you don't have a tax department in your firm. To your compliance department or your money laundering reporting officer if needed, and then also consider disengagement. We also have to make sure, don't we, that we manage communications really clearly. We have to avoid tipping off. We have to avoid expressing, kind of opinions on the outcome, keep the boundaries in place, and be mindful of privilege limitations as well. We do have to be prepared to decline or disengage and walk away if we can't get to a satisfactory position in terms of, getting to the bottom of what the actual commercial substance is behind these things. So in terms of takeaways, as non-tax specialists, you don't need to give tax advice, not expected to do that. And in fact, we're all bound by our professional bodies, codes of conduct, aren't we? Only to give advice in the areas that we are qualified and experienced in. So none of us should be stepping outside what we're actually trained and qualified to do. But you must be alert to that tax-driven risk and alert clients and other advisors to it. Substance beats labels every time. So regardless if something's been labelled as, a scheme that works or a loan or whatever it is, looking at the substance will overtake that every time. And as I think you've seen, artificiality is the common thread of all of this, isn't it? Is this just contrived in order to get a tax advantage? And early escalation is the protection against a lot of these things. It could protect you against money laundering risk. It could protect you against reputational risk and so on and so forth. Escalating it early is the key to all of this, really. And as with so many things, often with these things, it's if something seems too good to be true, it probably is. If someone's saying, I've got this great scheme where you can pay all your employees and not pay any national insurance contributions, it just doesn't sound right, does it? So I think sometimes we just have to think, does this make sense if I take a step back as an observer in this situation? Thank you for listening. If you do have any questions, you're welcome to put them in the chat. If you'd like to speak separately, I'm always on LinkedIn, as I think lots of you know. Feel free to message me on there, or contact us at hello@allegrotax.com, and we will come back to you. Always happy to have a chat if you're concerned about any of these types of matters. Our next Tax Insights Live session is on Wednesday, the 18th of February. I am keen to take suggestions from our clients and attendees on our webinars of what you'd like that to cover. So over the last year or so, I've done quite a wide range of sessions, but we always want to make this as relevant as possible to you. So if you do have anything you'd like us to cover in that session, please do get in touch. We're very, very, very keen to get your feedback. If you have any feedback on this session, always willing to hear what you found helpful, what you would have liked to be done differently. So please do get in touch about that as well. We don't have any questions in the chat, so I will end this here. Thank you very much for listening, and I look forward to seeing you next time.